Hey everyone, I hope you're doing well. It's PJ Patterson here for the market update for the week ending the 6th of December. Today is Friday. It's about midday, it's almost lunchtime. And just before I launch into our top three things today, I wanted to quickly mention, for those of you that don't know, that I've moved office. I'm now in my new office. I'm completely out of St. Leonard's now. I'm in Belrose, just a short drive from my house. It's absolutely awesome. I'm loving it. And I'll just show you the satellite view, just in a little building here. That's the super center there on Forest Way. Just a little building. All this area here is sort of light commercial or office space, and loving it. So I'll be looking forward to having you visit my new office at some point and have a yarn. So I'll look forward to that. Now let's get into what's going on in markets, and I also want to address today an article that a client of mine has sent along asking me to comment on. I saw it and I thought it was interesting, and I'd like to make a comment on it for them. It's related to Australian real estate. So, top three things today are: first of all, um, in global data on growth and other measures of growth and health of the global economy continue to slow and continue to look not so great. I'm going to show you some charts on that in a moment. I'm going to show you again some charts on inflation. So this item number two or point number two is going to be inflation. It continues to show signs that it's rising. And finally, point number three is going to be continued quad three investment profile. So what that means is that we look like, and I've been talking about this, that we might be possibly able to get into quad two at some point in the next 3 months, but the data is not signaling that, and certainly the market's not um, signaling that. So I'm going to talk a little bit about that. Let's jump straight into our first couple of slides on data. So ISM new order. So ISM stands for International Supply Managers, and it's a very interesting data series that is used to ascertain the health of the global economy and then of course your individual country economies. And what you can see here on this chart, here's one for new orders. So this is supply managers ordering inputs. Uh, that has fallen below the all-important 50 line. So in this data series, obviously it goes from 0 to 100, but in this data series, the 50 line above it is typically a measure of expansion. So that's good. Global economy is going well. They're ordering new things for their factories and their the supply chain to produce output. And then if it dips below 50, that's typically a sign of contraction or potentially even recession. And as you can see on this particular chart, there's two recessions noted by these gray bars where it did dip below 50, and then this is the GFC period here where it went significantly below 50, right down to the sort of 30 to 35 level. Very, very serious, as we all know back then. But here we are over here where we've just sort of slipped in November of this year, late October, early November this year. We slipped below that 50 line, and it continues to drop. So I'm not calling for there to be a recession or anything like that, but a comment I have previously made about um, a lot of these data points, you can still have negative growth. You can still have these things falling below 50 without a recession, because a recession, as I'm sure you all know, is defined as very simplistically by economists as two consecutive quarters of negative GDP growth. Um, so even if you don't get two consecutive quarters of negative GDP growth, you can still be in an environment where the economies are not going well, but um, you don't have a recession. So this is just the ISM manufacturing chart. Again, you can see that manufacturing activity slipped below that 50 line. And again, as you can see here, that red line, expansion contraction line. So this just signals that manufacturing is contracting. That's not good for the global economy. If you're looking for global growth and investing for global growth, these things are not signaling that. So that's item number one. And to that end, I just want to show you a couple of key stock markets. I've shown these charts before. This is Hong Kong, and I guess I'll just quickly mention the trade deal. Who could not have an update without mentioning the trade deal? We had some interesting tweets from Trump this week, I think on Tuesday, which effectively crashed the market by about, I think it went down about 3.5% over the course of a 2-day period. Might have even been up to 4%. and that was that clearly the trade deal is nowhere to be found, and Donald Trump suggested that he might just put the whole thing on hold until December, not December, of sort of November 2020 when there's an election. And this is very serious because a lot of Wall Street is hoping for and banking on the fact that we will have some sort of trade deal, and that traders and people, investors, feel that this is going to be a catalyst to return us to global growth. But the reality really is, and I've been talking about this for a while, the reality really is that a trade deal is not immediately and automatically going to cause a recovery in global economies. So a little bit of false hope there, I think. But the market seems to trade on the back of that. But in any case, if my point of showing you this chart and then this chart on the Shanghai is if the Chinese believe there was a trade deal, an imminent trade deal, they would be buying the heck out of Chinese equities and Chinese stocks. And these charts are showing you quite clearly that that is not what is taking place. In fact, the Hong Kong index is absolutely in sort of crash mode. It's down 20% plus over the last 12 months or so, and it's just looking horrendous. Shanghai is equally not looking that great. And I think I've got a couple of other charts to show you. Do I have a chart on? Yep, there's South Korea. Again, not believing that there's a trade deal imminent. And Dr. Copper, of course, also not believing there's a trade deal imminent. So all of these charts, the reason I show you this stuff is because you can garner a lot of information from the way markets are trading and the trend of those markets, and also the activity in a short and medium term. So just to pick on the Kospi for a second, you can see where the market's gone up and it's come down. It's gone up a little bit, it's bounced down, but within the lens of it going from left to right in a downward fashion. So these are the mini cycles within a longer term cycle, a downturn cycle. And the final point I'll make on this chart in particular is that what we're seeing is hype and hope, which is what we kind of had in October through November, early December in the trade talks and all that stuff. You remember that. And the markets were kind of rising off the back of that. But the reality is they rolled over, and they are signaling on this longer term trend that, again, they just really don't believe the hype. So you shouldn't either. Now let's pivot across to inflation. So just to show you a couple of updated charts on inflation, we continue to see the price of oil sort of slowly creeping up, and this is an inflationary sign. So oil typically responds to the US dollar and whether the dollar is strong or weak, but also responds to inflationary expectations. So what this is signaling, and look, if you look at this chart, oil is trading between sort of $55 and $59 a barrel, but as far back as October, it was trading down in the low sort of 50s, around $52.5, $53 a barrel. So over the course of 3-4 months, it has gone up a few dollars a barrel, but it's consistently held around that 55 plus level over the course of the last probably month and a half to 2 months. But again, signaling inflation. And where is I had a CRB chart. Let me just show you the CRB chart if I can find it. There we go. This is a Commodity Research Bureau chart. This is, I think, an index of about 35 to 40 commodities. And again, left to right, showing us that it is pricing in inflation. Now, the street, there was a chart here of the 10-year Treasury. On to point number 3. The 10-year Treasury, over the course of the last month and a bit, was sort of pricing in that we might be having a trade deal, and that we might be seeing the Fed pause or maybe even start to raise interest rates. Now, we got a Fed meeting coming up in the next week or two, and it'll be interesting to see what they say about the economy and the markets and everything else, because a lot of data points in the U.S. are showing signs of slowing. And the Fed is notoriously always behind the curve on these things. So effectively, they have not cut interest rates enough is really what I guess the point I'm trying to make here. And the 10-year Treasury, if you look at this chart, is telling you exactly that point. So, we've had this period probably since September where treasuries of yields have gone up, which means bond prices go down, then they sell off, yields come down, bond prices go up, and then we've kind of been in this little OODA loop on this for the last couple of months. But the thing is that the treasury, this 10-year treasury note has not broken out to the upside. So what we really need to see to believe that there is a recovery and that on its way, and that the Fed might need to shift its interest rate policy, we need to see this market and the 2-year and the 5-year Treasury, for that matter, pricing that in. It's not pricing that in. The last thing I'll say about that is another data point that's worth updating. We now have about, almost all 500 of the S&P 500 companies reporting, and we have negative earnings growth for this past month and quarter. So the issue now is where is the continued stock market pricing and elevated pricing going to come from? Because earnings growth is not happening in companies. It is in some sectors, but obviously broadly it is looking quite bad. And this could spill over next quarter into further poor earnings performance from companies. And there's a lot of gamesmanship that goes on around earnings. Companies typically will guide earnings down, and then they'll try to report a number that is better than the revised lower earnings and all this sort of stuff that goes on. But look, the point is just simply this. All of the data that I've been showing you and sharing with you and talking about with you is not suggesting that we're entering a quad 1 or quad 2 scenario anytime soon. Now, we could get that if the Fed and even the Australian Central Bank cut rates further, and the Fed's probably going to have to do that. But if they cut rates further, we will very likely see a nice bounce in the global economy, and particularly in things like manufacturing and the ISM numbers and even the PMI numbers, Purchase Managers Index, things like that. But right now, we're not getting that. So we have to be super careful how we invest. I'm sticking with the quad 3 call at this point, which means continuing to hold treasuries, continuing to hold interest rate sensitive stuff like REITs and utilities, and owning gold and things that perform well in an inflationary environment. So until that changes, I'm not going to change the investment style. And when it changes, or when it looks like it's changing, I will absolutely let you know and reposition portfolios. Now, let me just jump onto an article that was brought to my attention about home ownership. And this was on the Sydney Morning Herald a couple of days ago. And I spotted this. It's an opinion piece, and I spotted this headline, Home Ownership No Longer Sure Path to Wealth. And I thought, well, that's an interesting article. Certainly it's going to get some eyeballs reading it. And so I've just highlighted a few things, made a few notes. And I mean, of course, we have entered an environment right now where despite interest rate cuts, we have seen, because of the slowing economy, because of the financial regulation that's come in, we have definitely seen house prices come down. But just to address this no longer being a sure path to wealth, I mean, first of all, is there any sure path to wealth? Like, seriously, what person actually thinks that there's a lay down misere sure path to wealth? What I want to say about this is home ownership does one main thing for you as a, I'm just going to try to get my view going so you can see my face when I say this. What home ownership actually gives you is, first of all, it gives you a roof over your head. Secondly, it's kind of forced savings in that you are building equity in an asset, and so you're not paying rent. And by the time you get to, retirement or later stages in life, you might not, the next 50 years of home ownership in Australia might not look like, the last 50. But one thing is certain: if you do buy a home and you commit to holding it for the long term, so I'm talking 20 plus years, it will be worth more than what you paid for it, number one, because housing is a hedge against inflation. And secondly, you'll have an asset that you can potentially leverage off. I'm going to talk about that in a second, but you can potentially leverage off to create wealth in other areas. And I suppose thirdly, when you do get to your golden years and all of that, you will have a place to live. and your balance sheet, you will have an asset on your balance sheet, which I've already mentioned. So let's just address a couple of things. Why are we in this environment right now where somebody is going to write a piece that says homeownership no longer a sure path to wealth? Well, first of all, it's interest rates. I've made that note right there, and he says says as much in this article. And that is because interest rates have been falling for so long, it's given a tailwind to the property market. And we are at the point now of the interest rate curve where we don't have a lot more downside to interest rates. So naturally, the property market is going to slow just because of that reason. Now, there are other reasons why the property market could pick up, and that could be due to immigration. It could be due to birth rate. It could be due to even migration, internal migration in Australia. So some property markets may do better than others because we have migration, say from Sydney to Brisbane or Sydney to Melbourne, because property is cheaper there. But the main thing that's going to drive, I think, house prices over the next decade is going to relate to wage growth. Now, we've had very stagnant wage increase or wage growth in Australia for the last 10 years. I dare say it has not kept pace with inflation. And so what we may see is a round of wage increases that enable people to have more purchasing power because they've had pay rises. Now, that might underpin property prices. Will we get that? I have no idea. But interestingly, in this article, the author suggests that superannuation may be the path that people use to grow their wealth. I think that's a fantastic idea. I think you should have a number of things. Everyone should own a home, in my view. You should definitely invest in your superannuation. But sadly, what this author, maybe he just didn't have enough column space to mention this, but sadly what he doesn't really suggest is that there's a strategy around home ownership that everyone should be aware of, and that is debt recycling. I talk about that with my clients a lot, and that is you buy a principal place of residence, I think for two primary reasons. Number one, puts a roof over your head and you own it, can't get kicked out, and so forth and so on, as long as you pay your mortgage. So you're building wealth in an asset that you own. Secondly, it's capital gains tax-free when you sell it. And so if you do end up selling it at some point to trade up or to go into a retirement village or something like that in your golden years, you don't pay any tax on the accumulated in the equity that is available when you sell it. And hopefully we'll always be in a period where we see inflation impacting the price of the house. In other words, it's going to continue to go up. But one main thing about debt recycling that people don't understand is if you own a principal place of residence and you're paying off your mortgage and you're getting a little bit of equity growth in there as well because of the market, you can borrow against that asset to buy other assets that are not related to housing. So a quick example of this looks like this. Let's say you buy a house for $500,000, and after 5 years, the house is worth $700,000. And after 5 years, you've paid off let's say $100,000. So you've actually got, let's say, net equity in the home of maybe $300,000 or $400,000 if you're really lucky. What you can do is borrow, let's just say even $100,000. You can borrow $100,000 of that equity, and you can go buy a share portfolio, or you can invest in something other than property. And immediately what that does is it creates a tax-deductible opportunity for you because you can tax deduct the interest on that $100,000 loan. But what it does too is it creates another asset that is growing, hopefully growing outside of the property market, growing and adding wealth to your balance sheet. So that's just a very quick and very high level example of how to use debt recycling to your benefit. And you don't have to go out and buy investment property and do all that other sort of stuff that a lot of people do. You simply just borrow against your home once there's enough equity there to do it, keep the loan to value ratio below 80%. And you buy something that hopefully has a different asset profile or profile to real estate, to property. And then you wait and hope that goes up over time. I think I've used up enough of your time today. Thank you for joining me on this market update. And if there are any questions about it, or you have any comments or anything you'd like to say about it, please do put a comment in, shoot me an email, give me a call. I'm always happy to have a chat about markets and what's driving them and what's going on. Have a fantastic weekend, and I'll talk to you soon.